Hello, everyone. Today on the final bar, we will embrace the rally mode that the S&P and the rest of the equity environment appears to have engaged in, given all the sort of encouraging news going through into this market open this morning through the course of the day. It's been very positive, relatively across the board for equities. We'll talk about what this means for some of the other asset classes like bonds, gold pulling back a little bit. And today we're going to focus on the big picture, on sectors, on stocks. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to make sense of this market as much as we can from a technical perspective. Try to connect the short-term movements of what we're seeing today with the long-term trends. Try to understand momentum shifts, inflection points, and just focus on the charts as a way of understanding where things are going. Today, after last week when it felt like we were sort of establishing this trading range, right, between 2,800, 2,950, we're sort of settling into this range, trying to think about, what signals we would need to see on one way or the other. That 2,950 level is the upper end of the channel that we've been creating. Today we breached it, right? Pulled back a little bit and closed right about a 2,950, but certainly by any stretch of the imagination, today was an upside follow through for stock. So on Mondays, we hit the markets from big picture, the top-down macro, the bottom-up stock picking, and sector rotation. We're going to hit as much as we can in 30 minutes together to try to hit on some of the key themes. Now, we've had some fantastic guests on StockCharts TV and on this show in recent weeks, and this week is another great lineup of people to help us make sense of things. Todd Campbell is joining us from EB Capital Markets tomorrow on the show here. Todd's based in Boston. I've known his work and followed his work when I was on the institutional buy side. On Wednesday, we have Doug Bush coming to us from New York. He writes for Chart Smarter, does a really good job, and I love listening to people who are power users of StockCharts use it even better than I do. I always learn something from watching how someone like Doug uses the platform. And then Kim Sokoloff on the show for the first time, also from the New York area on Thursday. Earlier today, we had a conversation on Behind the Charts. If you missed it, go to our YouTube channel. This is our interview style show. And we sat down with Matt Lampert down at Elliott Wave International around mid-February. This is right before the market top, although we didn't know it at the time. And I remember asking Matt about euphoric signs of social mood, signs of excess, and what he would look for. And I think his answers are fascinating now that you know what's happened right after that interview. It was really cool hearing some of the warning signs he was paying attention to back at that point. So some great guests coming up. Let's get to the rest of this show, though, and we're going to start with our market recap. So, how do we make sense of a day like today? Let's look at what happened. We'll look at some of the charts, as many as we can get to, and then we'll try to pick on some key themes here. So the S&P really gapped up into the open and just was long and strong. Sold off a little bit into the close, but not much. The S&P still up over 3%, finishing around 2954. The NASDAQ up a little less than that, but still up pretty significantly, 2 to 2.5%, depending on which way you do it. The real impressive moves, though, were lower in the caps here. So mid caps up over 6%, small caps over 7%. So one of our 3 and 3 charts on Friday was looking at the relative strength of the IWM versus the spider. So the Russell 2000 ETF versus the spiders. Still, overall, the trend has been down. But days like today, where the small caps are doubling the upside move on a big update for the S&P, is very, very telling. The VIX now back below 30, so it's down about around 29.30. Now, other markets also had some pretty big moves, and we're going to look at some charts together. The bonds were actually down today over 2%, with the TLT finishing around 163. That's obviously pushed the 10-year yield back up to around 74, 75 basis points. In terms of commodities, gold, the big loser, down 0.75%. Oil up pretty significantly, and you can see that the energy sector was the number one sector, up over 8% today. So it's a pretty nice move for most commodities, with the exception of gold. down a little bit. So as we think about the chart of the S&P, let's look at this and start to think about some some different takeaways here. What we've talked about, and on Friday, if you missed it, we talked through the market trend model that I followed for years, which looks at short-term, medium-term, long-term based on exponential moving averages using the weekly chart. And the medium term, not quite bullish. If today was the end of the week, it certainly would turn bullish based on the movement you had today with the big gap higher. This gap has created what I would argue has been a bull flag pattern now with a big uptrend out of the March lows, this parallel downtrend of lower peaks and lower valleys. That's a counter trend move from that big move. We call that the flagpole. There's the flag, and if you confirm a break above the upper end, it basically, the general objective is you take the length of this flagpole, which is here, and you extend it to the top of the flag, the top of the breakout. And again, the back of the envelope measurement you can see it's way off the viewable area, puts the S&P around 3,600. It's a minimum objective if that is confirmed as a bull flag pattern. Now, again, given everything that's going on, I think you have a couple things to look for to decide that that's something you really think is reasonable. Number one, we still have not gotten above the 200-day moving average. We've talked about this range. We're now back in that range of resistance. We need to get a validated breakout above the 200-day, above 3,000 to really confirm further highs. That would push the RSI above 60, which is pretty important in a bull market environment as well. So we haven't seen that yet. But today certainly, giving, I think, a lot more positivity to the market trend from here. And certainly every one of the days like this makes S&P 2200, which would be a full retest of the low, seem more and more extremely irrelevant or extremely improbable. But again, you have to follow the trends. And what I'm seeing is a short-term correction. Instead of getting the breakdown through 2750, I'm seeing a breakout. And again, you confirm that tomorrow. And I think that suggests further upside. I think you have to continue to feel tactically bullish here. Now, there are a lot of ways to try to make sense of that. We're going to look at a couple of the charts here. I'm going to refresh this for the close. I'm not quite sure where things ended up, but one of the breadth measures you can look at is the percent of stocks up or down, so the advancers and decliners. By my quick read, 88% of the NYSE advanced today, 11 to 12% decline. It's probably just that rounding error that's unchanged. So it's not technically a 90% day, but honestly, I've found that those are, I think being less and less specific on some of those things, I think is more meaningful. I don't know if we necessarily need to get a 90% update. The fact that 88% of the New York Stock Exchange closed higher today tells me that that's certainly a wide, broad, significant move across the board. There are a handful of stocks that were down and a handful of groups that certainly underperformed. But overall, the average stock did very, very well today, and that speaks to the breadth of this rally that we've seen here. Another chart that we've talked about that I just want to look at very quickly is this one, where we're looking at the movements, the relative movements of the advanced decline lines. And one of the things we talked about on Friday was just the cumulative advanced decline lines all rolling over. These are not yet updated for today. I'm going to assume that they're going to come back up, but at the most recent signal was still a breakdown. So if you do see them break back and start to make a pattern of higher highs, higher lows, tells you the uptrend's resuming. And instead of being more neutral, which is what I would argue they are here, they'll turn back to a bullish signal. We've not quite had it yet. We're going to dig into some of the other sectors and stocks a little later because we're going to get to all of those. But I did want to just point out one more chart, which was the TLT, the bond ETF, long bond ETF. So one of the things we talked about into last week was the TLT coming to support at an ascending 50-day moving average. How important that is. Friday, you had this bearish engulfing pattern where you opened higher, you closed lower, and today certainly was a follow-through of that. We're now approaching support, and I think with the TLT, we now have just broken below the 50-day. We're now testing support from the most recent swing low, which is around 162. So if we get a close, if we get a follow-through below there, all of a sudden this starts to show that we're rotating back towards stocks, back away from bonds. This is more of a risk-on environment. And again, this was the first day. This is the impulse day. It's all about the confirmation of the validation you would see from tomorrow. So I think tomorrow tells us whether this is the beginning of something further or whether it was just the initial corrective move, sort of reaction to what happened over the weekend news-wise. That's our market recap for today. I had to tear through a number of charts, but I want to get to our next segment, which is sector setups. So when we talk about sectors, there's a couple ways we like to do it. One is using the relative rotation graph methodology, the RRG graphs. Then we'll look at some of the individual sector charts, talk about some of the themes that emerge from that. So with the RRG, what we're looking at are the 11 sectors rotating around the S&P 500 in the middle. If you're not familiar with this, my friend Julius DeKempner does a great job in his show, Sector Spotlight, breaking down this methodology. So check out some of his videos on our YouTube channel. Check it out live on StockCharts TV. But what we're looking at is the sectors rotating around the benchmark. Technology has been consistently one of the strongest places. It had been rotating back toward the weakening quadrant, now coming back up and firmly in the leading quadrant for now. What's interesting is healthcare, consumer staples, which had been emerging as the strength, and healthcare is still the strongest of the 11 based on the long-term weekly relative strength because it's furthest to the right. It's now rotating southwest. Consumer staples rotating southwest. Other sectors that are now rotating in a correction of more constructive movement: communication services, consumer discretionary. So now you sort of get the three horsemen here: consumer discretionary, comm services, technology, all aiming up and to the right, all increasing for the most part over the last couple of weeks, which suggests sort of that rotation back to a risk-on environment. Really interesting to see utilities and real estate from the leading quadrant in 4 weeks or less going back down, heading in the direction of weakness. And both of them very soon, most likely, will be in that lagging quadrant. You know, energy has been such a non-factor on this methodology because it's such an underperformer over the long term. If you look at the last, 4 to 6 weeks, it's turned so impressively and have rallied so nicely. I don't know if we're going to have enough time to get to some of the energy stocks when we get to our stock movement, shifting stocks segment later in the show. But energy is certainly impressing, and on a relative basis, out of the lows, you'd be hard pressed to find stocks that have done better than these bombed out energy names that have rallied so well. So, you know, it's interesting to see this is actually for the first time in I don't know how long threatening to get out of the lagging quadrant and go into the improvement quadrant. And again, if you're not in energy yet, it may suggest that you start to look, especially at some of the more constructive charts within there, which are building up actually very nicely. Industrials, financials, still on the weaker side, still have not improved enough based on this methodology to suggest any sort of overweight. It still suggests you stay away. But again, some of the charts that are really breaking out in industrials actually most impressive today, especially with the gap higher in the XLI. We're now looking at a candle glance page of the 11 S&P sectors and then the S&P 500 in the bottom right. And we do this just to look across 30,000 foot view. What do you see working? And the first thing that jumped out at on my review just a little bit before the show started was consumer discretionary back above its 200-day moving average. This has been a long time coming, to be honest with you. So the last time it was above its 200-day on a closing basis was back here in late February, early March. This is right at the initial sell-off. That gap down out of the February highs and then the push down through the 200-day really hasn't gotten back above there, has retested it a couple times over the last month, but set into this really consistent range with 110 on the lower side, 118 on the upper side, and that was the 200-day moving average as well. So it's sort of this beautiful little consolidation pattern, very similar to the S&P, but more beautifully range-bound, just consistent support and resistance. That's changed now, right? Today's gap higher from 115 up to 119 to 120, closing higher, closing out of this range really suggests further upside from here. On a relative basis, you can see how the relative strength's improved, and we're not gonna have time to look at that consumer discretionary versus consumer staples ratio. We've looked at it a number of times, certainly improving, and it's not just Amazon, it's across the board now, right? It's more of a broader improvement in consumer discretionary and a deterioration in some of those consumer staples charts, which we will hopefully have time to look at later in the show. So certainly a rotation back to the offensive side of consumer. And again, breakouts like this, and again, when it's getting above resistance, getting above the 200-day, if you're not throwing in the towel and deciding that there's upside to be had, I think charts like this have to sort of paint that side of the picture pretty nicely. In terms of other sectors, just a couple other very quickly. Financials still relatively low, and again, on a relative basis, just been so difficult. Gapped up nicely today and led pretty well for the day's session, but overall still, if you compare it to what we just looked at with consumer discretionary, you can see why it's not favored on the relative rotation work, because still on a relative basis, the trend has been negative, and it's because of other sectors like technology that have done so well. So let's look at the XLK to wrap up the segment. XLK has been a consistent relative performer, and you could look at the Qs or look at the NASDAQ composite. A lot of ways to sort of measure this technology outperformance story, but the XLK chart certainly validating it. Didn't quite make Actually, we did make a new closing high just barely today, and did not close above the highs from a couple weeks ago. But overall, certainly continuing this pattern of higher highs, higher lows. And I've seen enough of these patterns, and when we get to the shifting stock segment, you'll see what I'm talking about. A lot of these stocks that are continuing to break higher. So overall, the trend remains pretty positive today. Certainly felt like a vote of confidence on the bullish side from a sector basis, going away from defense and into offense. We're going to take a quick commercial break. Back actually to remind you about the birthday of the Buttonwood Agreement, the founding of the New York Stock Exchange. So we'll see you back in a minute. Hey everyone, welcome back to the show. This is Dave Keller here at StockCharts.com. As a reminder, send your questions to us anytime. The Final Bar at StockCharts.com. We'd love to answer your questions on our next mailbag segment tomorrow. This next quick segment, we actually met Jay Woods before the Christmas holiday, before the holiday season in December of last year. And one of the really cool moments was getting to see the Buttonwood Agreement in person, having him explain to us some of the history. Reason why we're bringing it up today is because yesterday, May 17th, was the 228th birthday of the New York Stock Exchange in the form of the Buttonwood Agreement. So here's our conversation with Jay Woods about the significance of this key pivotal document in American capitalism history.
This is our founding document, the Buttonwood Agreement. Wow. So this is what started it all. Yeah. This was an agreement signed in 1792 by the founding members of the New York Stock Exchange. Back in 1792, they used to trade outside. They traded under a buttonwood tree, which is a sycamore. As you can see, this is a sycamore behind it.
Right.
Little fact I learned the other day, it was called buttonwood. One of the reasons it was called buttonwood because the wood on the sycamore tree was used to make buttons back in the day. Who knew? Can't verify 100% accuracy on that, but yeah. It's a great story nonetheless.
Sure.
But this is important for many reasons. It set basically the guidelines for what we have today. Things have changed, but the rules haven't. And back then, these 24 members, they agreed to form a union where their word was their bond. And whenever a trade was consummated, it was a handshake deal. And if you said you bought and I said I sold, it was basically a deal based on our word. And if someone broke their word, they would be kicked out of the membership. So we like to highlight this here at the exchange. I know John Astor is one of the 24 members who signed this. You can go to Investopedia or your Google and find out a lot more information than I can tell you here. But we take great pride on having this document front and center for our guests to see because it is still relevant today, 227 years later. Yeah.
Wow. What can you tell us about? I mean, it's interesting. It was designed as a membership, sort of like they all come together as members. And it's funny that as the New York Stock Exchange grew, that idea of the membership continued, right? I mean, that was sort of the way it was structured.
I mean, these were the first broker-dealers of their time. They basically executed trades on behalf of their clientele, and they had a fixed commission, which was part of the agreement that they would trade, and that commission was a flat commission. In order to actually execute that trade, you had to use these members. Now, as we grew, the membership grew to 1,366 members, and each membership the members had what was known as seats. So you would buy a seat to trade on the exchange. Now, not everyone owned a seat. People would own a seat and then lease them out. I was on a lease for years. I never owned a seat. But in 2005, the membership ended as we went to a publicly traded company. And so there are no longer seats. There's a fee you have to pay to trade on the exchange, but the membership as it once was is no longer the same as it is today.
Right.
So now the Buttonwood tree is no longer on Wall Street.
Yeah, right.
It didn't stand the test of time. It came down in a storm, but the Buttonwood tree was 100 yards from here. This exchange is the third interior exchange because it was under the Buttonwood tree. We've been here since 1903, and it's hopefully here for another 100, 200 years.
It's good to share this history with viewers and with people outside of Wall Street, because I think most people kind of think that the exchanges started somewhere 1900, something like that, but the history goes back so much farther than I think people really understand.
And what they traded was a lot different than obviously. I mean, this helped finance the railroads and the expansion west, and let the economy grow.
So that was just a snippet of our conversation with Jay Woods at the New York Stock Exchange. Again, we recorded that back in December, and if you missed our documentary called The Big Board, it's in 2 segments. It's on our YouTube channel. It's a fascinating experience on the floor of the exchange with Jay. But there are not many documents from the 1700s that I've been able to sit and talk about with a knowledgeable guy like Jay Woods. And again, the foundation of that document that was built to establish trust, confidence, credibility for the New York Stock Exchange and encourage people to invest again. And it's really cool that still at this point, that's what's driving the thinking of the New York Stock Exchange. So happy birthday to the Buttonwood Agreement and the NYSE. We need to move on to our next segment called Shifting Stocks. And again, on Mondays, we've talked about the big picture, talked about some of the asset rotation. We've talked about sectors, looking at our sector setup segment. And now we're going to talk about shifting stocks. And as I've mentioned a number of times before, every weekend I like to go through the S&P 500, look at as many charts as I can, just to try to make sense of where things are headed. We're going to start with an index, actually. This is the New York FANG Plus Index, $NY FANG. This is something that was established a while ago, and it tracks not just the FANG stocks, but other similar stocks like Twitter, Tesla, sort of those new economy, quote unquote, types of names. And I think it's worth noting as the S&P, gapping higher, small caps leading the way up, this FANG index sort of testing its all-time highs from February. So it's round tripped essentially back to those previous highs. And again, as we're looking at the charts and thinking about what could propel stocks to its previous highs, 3,400 and so on, something like this breaking above its previous highs would certainly, I think, validate that idea more and more. And as I was looking at some of the charts, the reason why I'm starting here is charts of Amazon, Alphabet, Facebook, Netflix, most of these names, pretty constructive. Now, what's interesting in this sort of environment, though, and this is why a day like today is a little crazy. I know obviously there's some very positive news, with talking about reopening the economy, the Fed being very supportive, promising news on the vaccine front. And again, that's all sort of outside the scope of what we're doing on this show, but it's worth noting that was clearly fueling some optimism today. I don't know if all of that suggests would mean rationally that Norwegian Cruise Line should be up 18%. And then you look at something like Campbell Soup, CPB, as I'm looking at Staples, and it's down 5%. I don't think that news flow is going to compel me to stop eating soup tomorrow and book my next cruise. It's more of a process. And so I think that's what concerns me, looking at a lot of the charts you've seen over the weekend, they looked, pretty good to stable. And then all of a sudden today they start ripping up as in there's nowhere to go but up. And that sort of irrational move coming out of this, especially the rotation in consumers, what concerns me a little bit. Having said that, let's bang through some of the charts that caught my eye. A number of charts testing their 200-day from below. Nike jumped out at me looking at the consumer discretionary sector. So again, stocks like this being able to finally eclipse their 200-day and follow through. And that's what we've not seen yet. We've seen Nike stabilize at an RSI below 60. A number of times try to eclipse the 200-day. Last time we had this bearish engulfing pattern. So again, is this the time when we actually follow through and finish higher? I don't know. And if we pull back 85, sort of those lows from previous pullbacks would be really, really key. But that's one chart within consumer I'd be looking at. You also have charts like Target approaching pretty key resistance. This is more approaching the previous highs. Target actually topped out in December, but you get a lot of names within consumer sort of hitting that key resistance level or potential resistance. What is impressive, though, the move in home builders. So DR Horton up 10% today, gapping higher, breaking above resistance, breaking above its 200-day moving average. In that same group, you have things like Lennar with a similar sort of move. Not everything is in that same exact pattern, but a couple of the home builders certainly breaking out, and remaining in a pretty positive configuration. Again, maybe more along the lines of what we saw with Target. Best Buy caught my eye as approaching really significant resistance. This January, February was a double top. So if things like this can break above 90 can break above its previous highs, I think you have to be sort of mentally all in bullish. It hasn't happened yet though, and I think that's a big if. I mentioned the weakness in staples. I showed you Campbell's soup, General Mills, similar idea. And again, the fact that we're all going to stop eating soup and oatmeal so we can go on cruises and book flights, I don't see that happening immediately. So I think these movements in the charts I'm skeptical of the validity of them, but I have to follow the price. And you have bearish engulfing patterns on charts like this a couple times now in the last week, suggesting consumer staples certainly one of the more weaker places to be. Interesting within biotech, there's some potential issues there, and Gilead coming down. Gilead had obviously been one of the more promising biotech themes, now breaking to new swing lows, down 2% on a day when the market overall was pretty solid. Amgen actually testing resistance, but with a bearish engulfing pattern. Not everywhere in healthcare was bad. So you have something like TMO in the medical equipment space breaking to new highs today for the last 12 months, but closing down toward the low. So in healthcare, you saw that rotation lower on the RRG, and I'm concerned that these are what some of the charts look at. I do want to spend just a minute, and sorry, Gretchen, we're going to spend one more minute just looking at charts, and I wanted to show you within technology some incredible chart movements here. Visa and MasterCard both breaking above their 200-day and gapping higher. Visa was one of my bellwether stocks a couple years ago, along with a couple other names, and both of those sort of breaking higher. So, nice breakouts, nice resistance around the 200-day, and now capitulating, continuing further. Interesting to note, a lot of the semiconductors testing their 200 days from below. There's another group of stocks I would certainly watch. Applied Materials is in that bucket. AVGO is another stock in that similar sort of pattern. Micron, all of these sort of below the 200-day, not quite eclipsing them. So you'd want to see strength in semiconductors if you want to feel good about the overall environment, especially within technology. We just haven't seen it yet. So I think you want to be looking for some of those charts. Now, others, something like Skyworks has already blown through its 200-day, continuing to make new highs, new lows, nice patterns. But overall, some of those larger names like Micron, like Applied Materials, I think you still need to be looking for some upside follow through. And that's our segment, Shifting Stocks. Again, just coming out of my own review of a lot of stock charts over the weekend into this morning. We need to wrap our show, though. Mondays are so much fun going through all these charts, but has to end. We've got to get to our 3 and 3, and here we go. Chart number 1 is looking at the McClellan oscillator. We talked about this end of last week because it's a good measure of breadth. This is not updated quite yet for today because we do it after the close, after we process all the data. I wouldn't be surprised if it gets back around the zero line, if not a little bit higher. It had just at the end of last week, second half of last week, turned more on the negative side. And in general, it's on the positive. It's above zero. That's positive for stocks. Below zero, that's negative. That's based on breadth using the advanced decline line. So potentially an interesting one to watch going into the remainder of the week. Chart number 2 is looking at the percent of names that were able to close higher today, almost a 90% up day. 90% up days happen in bull phases. They don't tend to happen in bear phases. So that grouping of positive days like this would certainly fuel more of a bullish sentiment. And then finally, we looked at this New York FANG index when we were talking about the shifting stock segment. Again, we're talking about leadership as much as we've talked about the challenges of narrow leadership, especially the mega cap trade. I think you have to see with what's happened last week into this week, with today especially, you have things like mid caps, small caps really leading, almost doubling the return of the S&P going higher. So this FANG bucket of stocks doing very, very well. I'm looking at that, testing that 3,900 level to see if this index is able to propel it higher. That would be one of the guideposts I would look for to feel better about potentially upside for the markets as a whole. But you can't deny the relative strength that has been so strong. What I'm looking at now, though, is the fact that you had almost 90% of stocks higher today. You had small and mid caps doubling the return of the S&P going higher. So this was really more of a broad move. You're seeing breadth indicators starting to improve a little bit. It's all going to be about follow through, though, and I think that's what I'll be looking for tomorrow and through the rest of this week. So, folks, that's our show for today, hitting the market from 3 angles: top down, bottom up, sector rotation. As a reminder, we will do a segment answering your questions, the Final Bar mailbag, tomorrow. So shoot them to us via email, thefinalbar@stockcharts.com, or look us up on Twitter @FinalBarSCTV. All of our previous episodes and all the other great programming on Stock Charts TV is on our YouTube channel. Go check it out. Hit subscribe so you can get all of our new episodes. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.